Oh, yes. Hello, everyone. Good afternoon, and welcome to today's episode of Modesty's Property Corner, season number 1, episode number 23. Today, we are going to be talking about the recent Bank of England base rate hike. How does that affect you? If you live in England, you understand what I'm talking about, but at the moment, if you don't live in England, well, still stay tuned. You might learn a thing or two about how English economy works and the monetary policies and how it affects, because there is a central bank in every country. So what is applicable to the people of England might be applicable to you depending on wherever you are. But today we're going to be focusing on how it affects people who live in the UK. Recently, the Bank of England raised base rates to 1.25%. So they basically added 0.25% to the existing base rates, making it 1.25%. And it made the news, and a lot of analysis have been going on since then, just to help people understand how this really affects them and what this means to the ordinary person out there living in your house. And this is just a typical example of how certain things you think you're detached from actually affects other areas and other aspects of your lives. And these are the things we just want to look at and we want to analyze today, to bring to your notice how this simple decision can easily affect and influence certain things that you do right in your own home. So to do this, we are going to be looking at different aspects of our individual lives that this base rate hike possibly could have affected. We'll be looking at mortgages, how they impact on your mortgages, how they impact on housing markets, how they impact on pensions, how they impact on savings, even how they impact on tenants who are living in rented properties. So these are things that we are going to be looking at today, and I hope at the end of today it will help you make informed decision about your next move, about the things you're doing, about the monies you're spending, and just a general understanding of how certain things affect your financial life. Okay, so let's dive straight into this. So we all know what's base. I've been talking about base rates here for some time now, but just for the benefit of those who do not understand and for the benefit of those who are yet to get to grip with what this base rate thing is all about. Again, it is the rate at which the central bank, which in this case is the Bank of England, lends money to other smaller lenders or commercial banks or retail banks, as they may be called. Because the Bank of England or the central bank is regarded as the banker's bank. Okay, so the other banks, these retail banks like the Halifax, HSBC, Lloyds and all that, they go to the Bank of England to borrow money. And that money they lend to their customers at a premium with a margin on top of what the Bank of England has given to them for that money. So when they borrow the money at 1.25% from the Bank of England, they lend it to you in form of mortgages, loans, credit cards, hire purchases, and other credit products for a margin. So whatever is on top of that 1.25% is their own margin. So when the Bank of England raised the base rate to 1.25%, what they are trying to achieve is basically to try and control inflation, because it's a monetary policy tool that the Bank of England wants to use to control inflation. Inflation currently is over 9%, which is astronomical, and the target of the Bank of England is 2%. So raising the base rate is aimed at achieving, at least helping to control inflation, to see how quickly they can get that down to 9%. But this singular act of raising the base rate has, ripple effects on other things that revolves around credits and other things that revolves around our financial lives. So first of all, let's look at how this affects mortgages. Now, I'm going to focus on three major types of mortgages here at this, for the purpose of this session. Now, looking at tracker mortgages. If you're on tracker mortgages are mortgages that track the base rates. That's why they're called they track the base rate. So what they do is, if you're on tracker mortgage and the base rate goes up by say 0.25% like it just did, your tracker mortgage is going to go up by exactly the same margin. So if your tracker mortgage is 2.25%, for example, and the base rate goes up by 0.25%, your tracker mortgage will go up by 0.25% and will become 2.5%, and vice versa. If base rate goes down, your tracker mortgage will go down as well. So that's the value, that's the advantage of the tracker mortgage. It tracks the base rate. So when the base rate goes down, your tracker mortgage will go down. When it goes up, your tracker mortgage will go up. And then tracker mortgages will basically have minimum and maximum levels that they can go above. They have a minimum level that they cannot go below. So no matter how low the interest rate goes, the base rate goes, it must not go below a certain margin. But if you're on tracker mortgage, this might not be good. This is not good news for you, because the base rate has gone up by 0.25%. So your tracker mortgage is definitely going to go up by 0.25%. Okay, so what if you're on standard variable rate mortgage? The standard variable rate mortgage is basically fixed by the bank. It's set by the bank. It is the rates. It's that mortgage that can fluctuate, from time to time. So the bank can put it up, the bank can bring it down. So your mortgage payments, your monthly mortgage payments can be fluctuating from month to month, depending on what the bank decides to do with the standard variable rate. So if the bank decides to put up standard variable rate, your monthly mortgage payments will go up. If the bank decides to bring down standard variable rate, your monthly mortgage payments will go down. So when the base rate goes up, what happens to the standard variable rate mortgages? What happens is some banks will decide to either put it up or leave it as it is. Other banks will decide to wait and see how the market responds to that. For example, some standard variable rate mortgages today are priced as high as 4-point-something%, or even others at 5-point-something%. So if the standard variable rate is say over 5% or over 4%, and the base rate is 1.25%, the banks might say, well, there's enough margin already on it for us, so let's not put it up, let's leave it the way it is. For some lenders whose standard variable rates are really low, they might be thinking, okay, the margin is closing in now, we might want to put this up a little bit so that we can at least have some margin, some reasonable margin on the product. So they might decide to put the standard variable rate up to get some reasonable margin on that mortgage product. So because it fluctuates, and because the banks control this and they decide, when to put it or when not to put it up, it's not directly affected by the base rate increase, because the banks do that at their discretion, because it's not directly linked to the base rates. And in some cases, the standard variable rates don't really go up immediately. The base rate goes up, for example. So the base rate might go up this month, for example, and it will take another month or two for some banks to actually increase their standard variable rates. So they might just want to play it safe and see how the market reacts and get some traction in, and then put the standard variable rates up, because it's not directly related or linked to the base rates. What about fixed rate mortgages? For fixed rate mortgages, when your mortgage rate is fixed, it means your monthly repayment mortgage amount is fixed, the interest rate is fixed for a certain period. So, but where the problem is when that fixed rate period comes to an end. When the fixed rate period comes to an end, then you either have to fix it again, or it goes straight onto standard variable rate mortgage. So if it goes straight onto standard variable rate mortgage, it becomes more expensive in most cases. And if you do not fix it again, you stand either the risk of it going straight to standard variable rate mortgage, which might be more expensive to you, or at the time it is now coming to maturity, at the time that fixed rate is coming to an end, if it coincides, if you're so unlucky that it coincides with the time that the base rates are going up, you find out that a lot of the rates that are available in the market, even if you want to fix it again, a lot of those rates have gone up. So it's going to affect your next move. It's going to affect your next mortgage. It's going to affect, your the financial balance of things for you. Because if your current fixed rate is say at 1.25% and you fixed it for 5 years, and then that it's coming to an end now, you realize that the next best thing available to you by the time that one is end is at 2.5%. So that's almost double what you were paying at the time. And that's 1 second. Yeah. So that's almost double what you were paying at the time you took out that mortgage. So for fixed rate mortgages, again, it's not really directly linked to base rates, but then it could affect you if your fixed rate mortgage is coming to an end and you need to fix again. Okay, that's where you feel the pinch a little bit. And then what do we when it comes to the housing market, how does the base rate affect the housing market? Okay, here is the deal. Yeah, especially in the current circumstance, we all know that for the past couple of years, the pandemic has changed things a lot significantly. The housing market has taken a new turn since the pandemic. The housing market has almost become unrecognizable and has defied all odds in the last couple of years. So there has been property boom, there has been housing market boom in the last couple of years. Demand has gone through the roof. House prices have gone through the roof. House price growth has been astronomical. In the last 2 years alone, house prices have grown by 20%. So there is something that is fueling this house price growth and this huge surge in activities in the housing market. And one of the things that is fueling it is cheap mortgages. Because as at 2020, when the pandemic struck, the Bank of England crashed the base rate to as low as 0.1%. 0.1%. So at that time, people were getting mortgages for less than 1%. In fact, as at last year, 1 year ago, you could fix your mortgage for less than 1% if you were borrowing, say, 60 or 65% loan to value. But now, look at what the difference is, less than 1%. So cheap mortgages became very cheap since 2020. And because it became very cheap, the demand for houses, the demand for properties was surging. And what did it do? Because supply was either stagnant or was not meeting up with demand, house prices were soaring as well. So you could see the impact of that cheap mortgage on the housing market and on the housing growth. In the same vein, if those cheap mortgages begin to disappear off the shelves of the banks, what do you think is going to happen? There is every likelihood that it's going to affect the housing market in the same way, or in the same way it has affected it when the mortgages were cheap. So now we are witnessing a slowdown in activities in the housing market. We are witnessing a slowdown in demand. We are witnessing a slowdown in the overall movement of things in the housing market because the base rate keeps nudging up, interest rates keep nudging up, getting mortgages keep becoming more difficult. Affordability is now being squeezed by the banks. It's not as easy as it was to get those mortgages because the banks are very much aware of inflation. They are very much aware of the increased living costs, the living cost crisis. They are very much aware that it's becoming more expensive for people to pay their mortgages. So the banks have factored all this into their affordability, and affordability is becoming more and more difficult, as the day goes by. So the more expensive the cost of funds become, the more difficult it is for people to get mortgages. And then people have to make difficult decisions as well. Difficult decisions like, okay, do we really have to buy this house now, or should we just focus on keeping food on the table, keeping the heating on? Are we really ready to splash out big on this property that we want to buy now? People will have to make that decision. Even people who want to buy properties for investment purposes, like buy-to-let landlords, they will have to weigh between buying that investment property or keeping that money and using it for something else. So people will have to weigh those difficult and heavy and weighty decisions now, because it's no longer cheap to get these mortgages. So you can see the effect it's having on the housing market, and people having to make that decision, taking their time to make that decision. Now, this is not to say that the housing market will come to a halt or we go into reverse gear. No, this is just to say that the housing market has slowed down a bit. But has it really affected the price of houses? It has not affected house prices that much. The reason being that supply is still way short from where it's supposed to be. Demand is still way higher than supply. And as long as that imbalance remains so significant, it's still going to affect house prices, because it's still a business of demand and supply. If there are less houses to buy and there are more people looking to buy the houses, the sellers are obviously going to want the premium price for their properties, especially for decent properties. So if you've been in the market to look for houses now, you would understand and you will realize that, how it's not cheap. Yes, demand has slowed down, but house prices haven't come down with it, because house prices still react to the demand and supply graph in the market. So that's how it affects housing market. Now let's look at loans and credit cards and how the base rate affects loans and credit card. Okay, if you've got a loan at the moment, or a car loan or hire purchase, you know that if you took out that loan 5 years ago and it's a 5-year loan, it doesn't change anything. All right, what you agreed to pay 5 years ago is what you will continue to pay until you pay off that loan. It will only have an effect now if you are looking to go and take out a new loan. If you are looking to go and take out a new line of credit, that's when you will notice that it's no longer as cheap as it used to be. Because again, that money you are going to borrow from the bank, they borrowed it from Bank of England. All right, so just like it's affecting mortgages, it's also affecting loans and credit cards. As for credit cards are not borrowed for a fixed period. They are revolving credits. And because they are revolving credits, the interest rate on them can change at any time. So if you look at interest rates on credit cards, they are creeping up as well now. And it's becoming increasingly difficult and fewer in the market as well to get 0% credit card transfers. So the cost of funds are no longer as cheap as they used to be. So it has this overall effect and this overall impact on credit facilities that people are looking to borrow. In fact, one of the financial websites put it that £10,000 loan now costs over 4% in interest rates, right? About £10,000 loan now will cost you on average over 4% in interest rate. That tells you how expensive it is becoming. And the more this base rate goes up, the more likely these rates for these loans and these credit facilities are going to go up. So it affects basically everything that has to do with credit. But if you have borrowed that money before, like I said, on a hire purchase or car loan or personal loan that was fixed for a period of time, it is still fixed for that period of time. It doesn't change anything. Then savings. Okay, now this is an interesting one for savings. Yeah, how this affects savings. For a very long time, savers have been disadvantaged. For a very long time, it has been worthless saving or putting money in the savings account, because if you were putting money in your savings account, with intention of earning money off the interest on that amount, you're wasting your time. you're wasting your funds. You're going to end up poorer. So the only time it makes sense to save money is when you want to save it for a particular purpose or for emergency. Apart from that, if you're saving it to earn something on top of it and then to make you rich, you're wasting your time, because the savings rates have been so poor. In fact, as at 2020, some interest rates on some savings accounts were as little as 0.01%. Okay, now link it to what the base rate was at 2020, when the Bank of England, reduced the base rate to 0.1%. A lot of banks and financial institutions reduced their interest rate on savings to 0.01%, because then they can get very cheap funds from the banks, from the central bank, from the Bank of England. So there wasn't really that much appetite, for savings or to attract savers. So now that it's becoming increasingly more expensive to borrow from the central bank or from the Bank of England, it begins to make sense again to the banks and retail banks to woo savers and attract them into the bank for them to come and save money with them. Because guess what? It's a cheaper source of fund for them. So if you take your money to the bank and you give them that money and say, save this money for me, and they're offering you 0.75% interest rate, right, on your savings, which at this moment in time is really, really significant. It's really, really miles and miles away from what it was 2 years ago. In fact, some savings accounts now are paying as much as 1.15% on easy access accounts. And if it's an account that has restricted access for maybe 2 years, they can pay you a little bit more, up to 1.25 or 1.3%. Okay? That was unthinkable a couple of years ago. To pay over 1% on savings was unthinkable a couple of months ago, a couple of years ago. But that's how much difference the base rate hikes have made in savings. So now it's becoming attractive again to savers to go and save money. And this attraction to savings has a ripple effect on other fixed return financial products like bonds, because now people now have options. Okay, if I want to fix this money for 5 years in a different account or in a different investment or asset that promises me, say, 3.5% 5 years, as against earning 1.25% in my savings account. Okay, I need this money in 3 years' time, and these people are offering me a 3-year bond of 5%. Well, I'd rather go for the 3-year bond of 5% because I don't need the money until. So you could see it creates options, because then there is a basis for comparison. So if the need for saving the fund is short term, say 1 year time, yes, you can go to the bank and then give them the money, and then you take your 1.25%, for example. Makes a lot of sense. So this base rate hike to 1.25% now has an effect on the savings. So people are now beginning to become more confident to go and save, because yes, they don't need the money immediately, but at least there is something reasonable on top of it for them whenever they want to take it back. 1.something%, like I said, was unthinkable a couple of months ago. So that's really a good one for savers. So congratulations to all the savers, because yes, you you have become attractive once again to the lenders. So what about rents? People who live in rented properties, how does this affect them? Remember that the house you are living in, if you're a tenant, is owned by a landlord. And if that landlord took out a mortgage to buy that property, whatever happens in the mortgage market will affect that landlord and the mortgage. So if the landlord is paying a mortgage on a fixed term mortgage, and that fixed term is coming to an end, and it's coinciding with when interest rates have gone up, and it's looking to fix his mortgage again, and his mortgage has almost like doubled or more than doubled from what it was, when he or she fixed it, what do you think is going to happen? They are going to put up rents, because they cannot afford to swallow that cost alone. In fact, some buy-to-let mortgages, some landlords are having to pay extra £133 per month on top of what they're already paying. That's a significant increment in their mortgage cost. What they will do is they will pass that cost onto the tenants, who are going to be, in the form of increased rents. So if they increase the rents because their mortgage costs have gone up, that's reasonable, and you will not blame them for that. And it's because the rates for the mortgages have gone up. The banks are now, charging more for the funds that they are lending them, and they are bound to really transfer that cost to tenants. So as a tenant, you might be thinking, well, I don't have a mortgage, it's none of my business. If they could raise the rates to 5% for all I care, it doesn't bother me. It bothers only those who have got properties. You can see how it's affecting you now, because as someone who's living in a property with a mortgage on it, there is every chance that if the landlord is affected by the current mortgage market and it's affecting their costs, or the mortgage cost, they might transfer that cost to you. Unless you live in a property where either the landlord has no mortgage on it, or they are still in a fixed rate period, so there's really no reason for them to do that, for them to increase the rate, because it has not really affected their mortgage cost. They might decide to let it go. But if your landlord comes knocking on your door and saying, listen, I need another £150 on top of what you're paying because mortgages have gone up, please do not, the landlord is only reacting to what the market is, right? Okay, now the last but not the least are pensions. How does this affect pensions? There's something called annuity. Yeah, annuity is when you exchange your lump sum pension fund for a guaranteed income for a period of time. Yeah, say you have a pension of £100,000, a pension pot of £100,000, and this £100,000, you have an option of either drawing it down gradually whenever you want with your pension provider, or you take that £100,000 and you give it to an annuity provider and say, take this £100,000 and then offer me something that is a guaranteed income on this £100,000, either for the rest of my life or for an agreed period. That's an annuity. Okay, so that annuity is calculated based on a few things, and one of them, you will get what is called an annuity rate. So the rate that you are offered is the cost of that your lump sum. The annuity provider is saying to you, we're going to pay you a guaranteed amount of money every year or every month at this rate, based on what you have given to us. Deal or no deal, it's left for you. So that rate that you're being offered is somehow influenced as well by the base rates. Okay, so the base rate has an influence on that rate of annuity. So now that the base rate is going up, annuity rates are becoming more attractive as well again. So people who are seeking annuities are getting better rates than they used to get before now. Okay, but listen, this is just an analytical viewpoint. It's not an advice. It's not a financial advice, so please do not take it that I'm recommending annuities, I'm offering financial advice. No, I'm just analyzing how this affects annuities. If you want to discuss annuities and things regarding your pension, please go and see an independent financial advisor who will make your options known to you. But this is just to say that in this current market, and because of the base rate increasing, annuities are becoming the rate of annuities have become more attractive and becoming to make more sense. Even though annuities are not really very popular now, because since the pension freedom was introduced, annuities have not been really popular. All right, folks, this is where we wrap it up for today's session and today's episode. I hope this has been useful to you, and we have been able to break this down to you for you to really understand how these things affect your individual lives in different aspects and in different areas. If you've got any questions, please reach out to us on any of our social media channels. Look us up on Instagram, Modesty Properties.